is Anthony, and I'm here with Mr. Rogers here, who is from the Capital Markets Authority as an investor educator, to give us a little bit more of insights into the investment opportunities in the capital market space, as well as what you, first-time investor, is supposed to look out for if you're to invest on the capital markets, platform. Now, Mr. Rogers, we want to talk about what can I start with. I am, for example, a university student, and I save some little money, and I want to venture into this. Should I go into riskier ventures or less risky ventures? Then I'm also between 40 and 60, and maybe I know my time is not that much. Where should I invest?
Okay, thank you for that question. Basically, you'd look at it in two ways. If I'm going to invest in a risky venture, for example, I'm going to buy shares of companies. Generally shares go through cycles. There's a time when share prices tend to go down with the economy, of course, in which these companies operate. And then there's a time when they will tend to go up. So as a young investor, you have the time to wait, to be patient. Okay? So you can commit and invest in shares, and you're looking at a long-term investment. As long as in your mind you know this is money I'm committing and I won't need for 5 years, for 10 years, then it would be good to go into shares. But as you grow older, as you get older, you might not have the time to wait for those cycles to pass. So your portfolio should be geared more into safe investments. So if I'm young and I'm having my portfolio, I'm committing maybe 70% of my money into shares of companies. Then I can say the 30% will be invested where there's low risk. I can pick some bonds, I can pick some investments in treasury bills, right? Because I know if I need money, I'm able to go for the short term and pick some money and use it. But then I'm committing most of my money into a long-term investment, right? But then as you get older, and then you consider that the portfolio now reverses, so that you have more money invested in where it's safe or low-risk assets like treasury bills and bonds, or investing through collective investment schemes, or in a fund where which is investing in those in those options. So I'll have maybe 80% or even 90% of my money invested in safer assets. Then I can commit as little as possible in shares, which are a little bit more risky and are more volatile. Yes.
Young people also have a problem. They don't want to wait. That is another problem. They want to gain faster, and now you're telling them they should invest in these equities that are probably long term. What should be the advice? Should it be waiting, patiently for the money to accumulate, or actually we should go for what brings money right now?
I think it's risk versus return. Normally, when the return is slightly higher, the risk is also higher, right? So if you say you want money right now, then you might actually put it there, and then share prices go down, and then you're in a loss. So will you get it out when you're in a deep hole? Let's say share prices generally have gone down 30-40%. You invested 1 million, now it's 600,000. Would you want to pick it from the fund? No, you wouldn't want to. So that's why even if you're young, I think you need to be able to wait. You can actually build this one up. You don't have to put all the money at once. If you, for example, you've started working, you can start building this portfolio slowly. You commit a certain amount of money monthly to investing in this, where you know you're going to wait. Then, like I mentioned, at least have some safe investment where you know that if something happens within 1 or 2 days, I can pull this money and use it. Because like we had COVID, we had never experienced it before, but it came, and people needed money. They were at home, some lost their jobs. But if you had money now invested in a safe asset like a collective investment scheme in a money market fund, then fund managers were actually able to pay throughout COVID. So if you had your savings already, you'd be able to access that money. But then again, shares reacted badly to that situation because it's risky. They were not sure what is going to happen next. So most share prices actually went down. So would you want now to pick your money during that time? No. It's good to balance it up a little bit. Have some money in short-term investments and then have some money in long-term investments. Yes.
Good. Now, given the fact that people are now embracing, for example, the collective investment scheme,
Yes.
and of course, this comes with a lot of issues with people who want to take advantage, of people's monies and so on.
Yes.
You've talked about the regulator, licensing all these people, but there are these other people who come in form of cryptocurrency, in form of other investment schemes. They also call them schemes. Everyone calls it a scheme.
Yes.
But they're actually not regulated. Are these also safe investments, or even are they valid, even if they're not listed on? Licensed by CMA?
I think, of course, you can invest outside what CMA has actually put across and is supervising. But I think the key thing is invest in things you understand.
Yes. Okay.
Yeah. If somebody explains to you how cryptocurrencies work and you're not able to understand it and doesn't make sense to you, then put their money you can afford to lose. Yeah, because there you're not sure, right? It's something you don't understand. So why should you put all your money in it? I'm thinking if you really want to try it and you want to understand it, I'm not saying it might not work or it will work. Put as little as possible so that you get to understand or learn it before you commit more money into it. Yes. So invest in things you do understand, and if you don't, jump in with one leg. Put little money that you can afford to lose. Yeah. If you work maybe 100 million, then you can afford to lose 500,000. So if you start with as low as 500,000, then you will be able to understand what you're doing. If you never understand it, then you can forget about it. So the bottom line is invest in things that you understand. Yeah.
Let's compare a fixed deposit account to probably a collective investment scheme. What would you advise an investor to choose? Because we understand fixed deposit accounts, I think 6 months or something, 1 year, and then you come with some return.
Yes.
What would you advise an investor to invest in? Would you rather invest in a fixed deposit account than a collective investment scheme?
I think it will go down to rate. What are you actually offering me, right? So if I go to a CIS and they're telling me the rate is 10.3, right? And they're telling me that's exactly what I'm going to get. If you give us your money, for example, for the full year, we're going to pay you 11%. Then I approach a bank and it's telling me for a full year, we're going to pay you 15%, right? And even if you factor in tax, the fact that I'll have to pay withholding tax on this deposit, it means I'm actually making more money. But you'll hardly actually get a rate that is as high as that, especially for amounts that are small. Yeah, but if a person who is transacting in billions, sure, if you approach a bank, I'm sure you'll be able to get a bank that would offer you a much higher rate. So it goes back to what is on offer. Yeah, is the bank offering me something better, or is the CIS offering me something better? But from experience, I know the CIS managers are actually offering better rates. Yes.
CIS? Huh?
Yes.
Now, I have my salary. Maybe I get, let me give an example, 1 million. I get 1 million. Let's make it a little bit practical.
Yes.
I want savings. I want, money to use at home. I have some other emergencies. Which money should I always dedicate to investing in my capital markets? Because I understand we are living in very hard economic times, where prices have gone up. People are just literally trying to live by. Yes.
Yes.
But still, we need to invest for the future.
True.
So how do I break it down so that I can actually turn out, better in the future?
Of course, it will also start with the kind of expenses you incur on a monthly basis. So let me assume maybe out of 1 million, you're able to use 600 or 700,000. Then it means you have an extra 400,000, and you have to plan and be specific and make a decision and say, I will try as much as possible to live within 600,000 a month. Okay, if it means leaving the house you're currently or renting or occupying and going into one where you'll pay less, you make that decision and you stick by it, so that you have a specific sum of money intended for savings. Right? You have to put something aside. So say, let's say you decided to put 400,000 aside on a monthly basis. Then you can say, I'll commit, depending on how old you are, I'll commit maybe of the 400,000, let me say 200,000, I put it in a short-term investment. I do a CIS, right? And I have that monthly going into a CIS where it's short-term. I know if there's an emergency and I need 500,000 and I've accumulated 5 million or 2 million, they'll be able to send back that portion. Then I'll say the next 200,000, I can commit it in a long-term investment, right? And you know, the beauty with the CIS or the short-term investment, they will also lead into your other objectives. Maybe you want to buy a plot of land after a year or two, right? You're putting money aside. The moment then you've raised money in your CIS, it's now 10 or 5 million, and you're able to get a plot of land at 10, I hope, with the prices going up. But if you're able to do that, then you can pick the money and then go acquire that asset now, so that you have these short-term and long-term objectives. But you have to be saving for both of them.
Yes.
You know.
Yeah.
Yes.
So you always don't invest, put all your eggs in one basket.
No.
Yeah.
That's not advisable.
Okay.
Yeah.
There's now a downslide where people actually are seeing increasing prices of fuel and so on, and governments are coming up with a higher interest rate, for the central bank rate, like the Kenyan banks now, and we are expecting ours as well to go up very soon. How do these capital markets influence these, especially in terms of now the treasury bonds and bills? How do they influence these price inflation? How does Bank of Uganda use these rates to influence inflation?
I think Bank of Uganda is key. Of course, the central bank rate that they set kind of influences the rest of the other investments. You'd expect that if the central bank raised its rate, then the treasury bill rates should also follow or go in tandem. I'll give an example of what has already happened. I think before COVID, the lowest central bank rate we've had was 10%. It was reduced up to even 6.5% with COVID and all that. And you could see in the market, due to that, the treasury bill rates also went down. They kept on going down to up to also 6 in the levels of 6% for 1 year. So if the central bank rate is increased, then you'd expect also the other rates in the market to pick up. Yes.
So it's all in tandem.
All in tandem, yes. Yeah.
Wow. Now let's say I have a treasury bond that I've invested in, and I've not gone through a broker. I want to do it myself.
Yes.
Is there a provision for that?
Yes, you can. Actually, you can invest in a bond through your bank. They are primary dealers and secondary dealers, but any bank that you approach, a commercial bank, will be able to help you invest in a treasury bond directly. They'll take you through the process of opening an SCD account, and then they'll transact for you, because it means you'll have to go through them to invest, and then when it matures, still money will be sent back to your bank account. So the commercial banks, you can approach your bank.
The commercial bank,
yes, and they will help you do that.
You talked about SCD account. That is something as well that probably confuses people. Do I always need an SCD? What is even an SCD account in the first place?
That is a Securities Central Depository account. If you're to invest in treasuries directly, then you need it, right? Because they will need you to transact. Even if you're also investing in shares, a broker will help you open one, because it's your reference. They will use it to report back to you. In the system that you must have an account. Nowadays, you no longer have share certificates, physical share certificates. So all the information is electronic. So it means you'd have to open an account to be able to transact. So to invest in shares directly, to invest in bonds directly, then you'll need that account. But if you're investing through collective investment schemes, then you're not necessarily opening that, because on their side they will create an account in their system, and then you can transact with that account or manager account that you have, and then back to your commercial bank account. Because when you're sending them money, it goes to their custody accounts, and then when you want to withdraw, the CIS manager will send the money back to your bank account. Yes.
Oh, so it's a necessity to have an SCD account
if you're going to invest directly in the capital markets.
Yes.
But it's simple, it's not complicated. If you approach a broker or a bank, they will set it up easily for you. Yes.
Now, as the Capital Markets Authority, what have you done to make sure that investors, actually the probable investors, if I can say, get interested? Because as we have seen, we have said, people actually are still not aware of all these opportunities and benefits that they can gain from it. And a window trader, someone who is doing business in Chikugo, and a farmer in Chiboga, they don't know they can keep their money somewhere, and it gives them returns. But what has the Capital Markets Authority done to change this?
Of course, CMA does really a lot, but as somebody who is representing them on the investor education program, I think they have done a lot on that side. And the best they can do is to actually inform the public, although they are doing more than that, because they still have to supervise these entities and regulate them, make sure new products are approved in the market and all that. So, but the bottom line is the awareness that they are trying to create. And that's why I'm here today, for example. And they are having talk shows on radio, on TV. They are trying to reach as many people as possible. Part of the program also involves us traveling up country to organize presentations to institutions, to people, to circles. So it also means that if you're out there and you have a group, for example, and you want somebody from CMA to come and engage you directly, you can approach CMA and they will send a representative to come and take you through this. So CMA is doing a lot to educate the program, and they are willing to go anywhere within Uganda to do this.
Now, for companies that want to be, for example, listed on the exchange, what are some of the incentives that are there for them? What can be something that they say, okay, if I'm a listed company, I have these benefits? Because as well, on our exchange, we realize we have about 16, 17, 18 companies that are listed. But you go to Nairobi, they have over 65. Dar es Salaam, they have more companies. Rwanda, which are actually young stock exchanges. How can we attract these companies, and what are some of the benefits of having the company listed anyway, on the exchange?
And I think the key bit is what you're getting from the capital markets as a listed company. And CMA has tried to simplify this to the extent that even small companies can actually list. There's what we call an alternative market segment, where you can actually list as a small company. And if you approach CMA, they will give you all the requirements for you to do that. But what is the benefit? Why should a company list? I think that's the key question here. The benefit is patient capital. That's the benefit. Because if you're listing, then you're picking money from the public. These investors are going to put money into your company. Now, compare this to approaching a bank and you borrow an amount of money, right? This is money you have to pay back, maybe in 5 years. It's also hard to get even long-term capital from these banks. It's hard to go to a bank and you want a loan for 20 years, right? But if you list on the exchange and you get money from the public, if you give people an opportunity to own shares, they are part of the company, they are shareholders, they're not going anywhere. This is patient capital that's going to stay with the firm for 20, 30, 50 years. People can still buy and sell their shares on the exchange, right? Because the platform is there, the securities exchange is there for people to actually be able to sell and transact. So I've bought your share, I can transfer it to somebody else. But as a company, you have patient capital. You've gotten money that you're going to use for a lifetime. So the key bit here about listing is patient capital. Yes.
So how it works is that people who buy in the initial public offer, they don't declare any new shares. Is that it? They'll be like, after the initial public offer, we are now only trading already bought shares. Is that how it works?
Okay.
Or the company can declare new shares after?
Okay, there are actual opportunities to issue more shares. So it's up to the company. If they decide they want more, they can actually issue more shares and have another offer available to the public for people to buy more shares. Yes, but if they don't, then it means the investors are able to trade in that range of the issued capital. Yes.
Wow, that's very, very interesting right there. And you've also talked about the alternative market segment for small and medium enterprises.
Yes.
Let's talk a little bit more about that one. For which particular companies does it look out for?
Okay, I can't give the specific details, but again, if you approach CMA, they will give you the breakdown. But in a nutshell, you're looking at the size. If you're not a big company, the requirements to list might be overwhelming. So they put an option for the small companies, and the requirements are not as cumbersome as for the other huge companies. Yes, but for details, you'd have to approach CMA, and they would provide that information.
Let's say a company closes in Uganda, and it was listed on the exchange, and people have invested in the company for a very long time. Example, let me say Uchumi, like the way it closed. People fear that maybe their shares will be lost. Is that the case, or there is actually a backup fund that could finance people who have been trading in a company that's closing?
I think when you buy a share of a company, there's also need to do a little bit of due diligence. It's that's why we categorize it as a high risk investment compared, let's say, for example, investing in treasury bills and bonds. That's almost risk free, right? You're sure the money will come back, right? But when you buy a share of a company, then you're a shareholder, you're exposed to the risk that the company is undertaking. So I think it's due diligence. Even when you have the shares of the company, at least attend the AGMs, make sure you read those reports. If the company is struggling, you can be able to tell. It won't happen in one night, so that you're able to exit in time. Yes.
Annual general meeting, you've talked about that. I had forgotten. MTN just had one this last Friday.
Yes.
What's the relevance of an annual general meeting, and why is it important for shareholders?
I think it's an opportunity for you as a shareholder to ask the questions directly, because they will give you an opportunity that if you want something to be addressed, and they send us these questions even prior to the meeting. So it's a kind of one-on-one engagement where if there's something burning, something you want to know about the company that you invested in, you have an opportunity to ask. But they're also giving you how the company has performed, and they're taking you through what happened throughout the year. Because there's a lot that can happen in a year. I think it's reporting back to you as an investor and giving you also an opportunity to you as an investor to ask them and get to know what you want to know. Yes.
So it's a mandate of the shareholder to actually attend the general
Yes,
meeting.
I know many shareholders don't actually attend, but as long as you look for information and you're informed of what is happening, I think it's good. But as far as the company is concerned, it's a mandate. They must report back to the shareholders. Yes.
In your view, are banks and capital markets in a kind of competition, or they're actually both separate and entities that are both in different sectors? Because as we see, investment in a capital market is like investing savings, right?
Yes.
But still the banks have the same offers as the capital markets, or the two actually play along the same field.
I think it's the same field. Of course, they're all trying to attract your money. Bank is making sure you give them the money that you've saved, so they're able to lend it to other people and make a profit, and also give you part of the profit in form of interest. And the capital markets are also trying to attract capital, right? There are people who are looking for money, and there are people who are looking to lend. So I think they play in the same market. It's up to the investor to choose where to go, and depending on the interests that they have.
And finally, as we conclude, we draw to the conclusion, we would like to know what are opportunities for careers in the capital market space. I know there are young people who watch this program, and they probably want to work with Capital Markets Authority or with the Uganda Securities Exchange, but there is no particular career they know that this is in line with this. What are some of the career opportunities that capital markets actually offer?
I think I would just put it as a financial sector, because if you're doing something to do with finance, accounting, the opportunities actually enter into the capital markets industry. But at the professional point of view, if you're looking to be really a top professional in the capital markets industry, then you should be looking at the top qualifications like CFA.
Yes.
Yeah, if you're looking at CFA, Nairobi through CASNEB, I know they offer something called CIFA, which is Chartered Investment and Financial Analyst. So that's the kind of space you'll be playing into. But if you're in the financial sector, then there are opportunities to do, for example, CFA, and then you'll be a fully fledged international professional for the capital markets.
Wow.
Yes.
Wow, beautiful. There you have it, ladies and gentlemen. That was Mr. Rogers here. Maybe before we close, you can give your parting shots to the viewers out there, encouraging them to actually embrace capital markets.
And as we close this, really, to me, no matter how much you're earning,